if you're out there and want to get in the game, whether you're a new person, this is the time to get in there. Look at new builds. Go make 20 lowball offers on properties with Jeff. I think there's opportunities in the syndication side now. The people who have deals that went sideways, that's the internet. That's public. It's washed out those bad operators. And so the people that are still around, for the most part, they're good people that navigate the market, but they've got durations. And now the deal flow is starting to come back on both of those. I am bearish on the market, but I'm bullish on the opportunities. What's up, Colorado? Chris Lopez here, and today's show is going to be our June monthly market roundup. We're going to talk trends, we're going to talk some articles, and we'll talk some deals. So I am fortunate enough to have the full crew here today. Troy Howell with Nova Home Loans. What's up, Troy?
Hey, just living the dream one day at a time, Chris.
Love it. Jeff White with Envision Advisors. Always good to have you back, Jeff.
Happy to be here. Thanks,
Brandon
Chris.
Scholten with Keyrenter.
Hello.
And last but not least, Jenny Bayless down the Springs. How are you, Jenny?
I'm doing well. How about you guys?
Really good.
Excellent.
We got lots of fun stuff to talk about today. Market is getting more interesting, I think would be the right four-letter word to say on here. But let's jump off with the trends like we always do. Now, Jenny, I am pulling up PPAR June report here. Walk us through what you are seeing down in Springs in Southern Colorado.
Well, something I didn't have on my bingo card was the month-over-month increase in median sales price was up 2% to $500,000, which, don't quote me on this, but I think might be one of the highest median sales prices we've seen. I'm not sure. It might have crested 500 at some point a couple of years ago, but I mean, that's pretty significant. So that was the biggest surprise to me. Average sales prices also up a little bit from month over month, 566,000 to 570,000. Total active is up as well. And sales also went up and new listings went down month over month. So I don't know. It seems more competitive for June than it has in quite some time. So I thought that was pretty interesting.
Yeah, you got any? Are you feeling anything different in the market down there? Or like putting the stats aside, are you getting a different vibe or anything from clients or other pros down there?
No, not really. Just like I mentioned, I think last week or last month, we we're chatting with someone who's interested in purchasing a fourplex, and he and I went shopping a little bit, and just the numbers, what they're listed at is not working on his end. And the sellers are just not, in a hurry. They're not motivated to sell on their end. So I think it's just kind of, everyone's at a bit of a standstill. It's very interesting, to say the least. So oh, sorry, go ahead.
Okay, what type of cap rates are you seeing down there with fourplex? It's kind of where the sellers are at right now.
I would say the ones that we were looking at were high fives, low sixes, which is way better than they were a few years ago. It's just that interest is just gobbling up any sort of cash flow that might even be possible. So it's very interesting. I'm super curious to see kind of what's going to move the needle, what's going to actually be the breakthrough, I guess, to get, at least the multifamilies moving. Because, like we talked about last month, sellers are generally not, majorly pinched. I think they're just looking to sell. And if it works out, good. If not, then not, they'll just keep holding it. And buyers are just not making it able to pencil. So I'm very curious to see kind of what's going to have to happen, or maybe nothing has to happen. Just be like in a lull for a year or so. Who knows?
Did you actually put any like lowball offers in, or were you just talking with agents to feel them out and there was just no room to wiggle?
So I asked the client, I said, go home and run your numbers. And he did. And I chatted with the agents of the properties that he was interested in. And I told them what he would need to buy it for. And, they politely told me that's not going to work. So, I mean, I get it. I get it from both sides. So, it is what it is. But
will a day come where we say, man, we should have been buying more in 2025?
I think right now is, I think especially like the latter half of this year, I think it's going to be a really good buying opportunity. Like, I think there's a lot of people are in like comfortable positions. Like I just withdrew my fourplex from the market. because I'm it cash flows well. I got 3.5% debt. I can ride it out. Mine was an opportunistic sale. I did not need to sell. I wanted to just go, move the capital around, but like I'm not gonna shave off $250,000 from what I think it's worth, and where it was a couple of years. Like I'll hold on for another year or two. Market picks up, paid on principal, and hopefully sell it for more than I can now, probably less than I could a couple of years ago. But I think that's how a lot of the sellers are now. I think a lot of people in that position. But I mean, if you go through like life events, a death, a divorce, moving out of the state for a job, like I think there will, and some people bought right at the top and are pinched now. Like I think there'll be a small minority of properties out there that truly are distressed, and I think there'll be some really good buying opportunities. Like this is the most, I say bullish in the sense, I'm very bearish on the market right now, but bullish in the sense of like there are some really good buying opportunities if you go out there and hunt, and as Jeff says, put in some disrespectful offers. And that's one thing I've been amazed at. Like I've had 0 offers in my fourplex, 0 verbals to the broker. It sounds like I was at least expecting someone to like at least throw me a little offer, right? Like I was just hoping for it just to see.
Let's
like,
talk.
But like,
this is the
going through something.
Yeah, I was gonna say this is the first time in a long time that I've told the client, yeah, go home, run your numbers, let me know what you want me to throw out there. And I asked the agents not to block me when I was about to say what that was, and everyone was very cordial about it. But this is the first time in a long time that I'm like, well, you could just see. We have no idea what they're thinking or what they're needing or wanting. So the worst that they can say is no in that case. So I'm surprised you didn't get a low ball either.
Yeah, and I mean that's part of the reason I was like, I'll just lower the price and I'll hang out. Part of it just wanted to kind of see what the market was, right? Just for commentary, talk about podcast. But I think a lot of like agents and a lot of buyers, I think they're, I don't want to say too afraid, but still in the mindset of, lowball offers are pointless. It's like, dude, this is the time to make some aggressive offers. Like, 3 years ago, get the heck out of here now. Like, at least bring an offer. Like, write something.
Exactly. Yeah, it's almost like it's lulled the investor community to sleep, but they're just like, there's no deal. So people stopped looking or bothering with
or if they go out of state.
Okay.
They just want to say, too expensive, I'll go to Oklahoma or somewhere like that, right?
Yeah. But if you can get a property for 20% off what it was, the peak 3 years ago, like I'm like, it sucks right now, but hold on for 5 or 10 years. I think you're in a good spot.
How far off, Jenny, were these when your buyer penciled them out? Like how low ball are we talking?
One was fairly significant. And then the other one, the other one, the agent told me that she would ask her client. Mind you, I haven't heard back, so I'm guessing that's a no. But I'm guessing that they
like
previously
80% of list price.
Oh gosh, making me do math. Yes, I would probably say like 85% if I could eyeball it real quick. But the list price was already quite low in that one. So
Should have tried anyways, Jenny.
I did. I tried anyways. Yeah.
Or just throw in the offer and just to see what they say, because then you have to present it to the seller, right? And
I mean, she seemed like she was in fact going to tell her. So,
because if you submit it and then you put it out there, because if they have no interest, you have no competition, right? So if you put it out there and then you wait a couple weeks and then say, hey, my buyer's still interested, or offer still stands, because it's just a question of motivated seller, because like Chris just alluded to, is death, divorce, tax reasons,
job relocations.
Like sometimes sellers have to sell no matter what. Like they can't just pull a Chris and try to sell a 3.5% interest rate. Amazing. That's 30-year spec. I can't even say it because I'm so sad that he's trying to sell it. But I'm
not anymore. No one wants it. Or at least anywhere the price
finally prevailed.
Yeah, but even Chris was selling for more or less tax or reallocation of capital. Yeah. So you didn't have to sell. But what if some people, like your job, like let's say your job moved out of state and you have to sell the place because you need the down payment. Some people need to sell, and those, they don't advertise, oh yeah, my seller is going to take 20% off the list price. No one advertises that. But when you submit the offer, see what they say, come back a week, 2 weeks, 3 weeks later, hey, we still have the same offer. because if they're getting no calls, it's like it's only a matter of time till you find that motivated seller. There is sellers out there right now that would take even 20% off list price.
Yeah, but you have to go through numbers. Go make 20 offers.
Yeah, that's a lot of offers. Yeah.
And like I think about this time last year, I mean, Jeff, you had a client buy a fourplex, I think, kind of East Denver or so, and it was an estate sale, right?
Yeah.
There's an investor who unfortunately passed away, and hey, that's the type of stuff where it's going to trade because the estate's going to sell it.
Yeah.
All right, so for Denver trends here. Let me pull up this data on here. So this is the DMAR report on here. So our active listings at the end of June was about 14,000, which is 37% higher than it was a year ago, but just a little bit higher, like 3% higher than it was in May. So not a huge increase on there. Oh, you can't see that, huh? Thank you, Brandon.
Yeah.
There we go. Helps if you can see, huh? So yeah, and of course these stats we're sharing, we can they're on the blog post. Or email me and Jenny. We're happy to forward to you them as well. But residential combined, we're still up in prices here, year over year, about 3.5% on average price, and about 1.7 in median price. Now, of course, we're going to see a delta here on detached versus attached. I mean, year over year, we're down 5% on condos on average, or attached homes. And I think, Jenny, I'm going to flip back to here. I meant to bring this up while you were talking. I mean, it looks like your condos and townhomes are actually getting pummeled, right? Your average sale price down 11% year over year.
Yeah, but I mean, look at the quantity that we're talking about too.
How much is the quantity on here?
A couple hundred units. So, I mean, I think it's more of a dramatic impact on that. But I know I mentioned it a few months ago, but I mean, it's just the HOA is just crazy now with insurance, like, these large roof policies. Insurance providers don't want to be on the hook for, a massive complex full of roofs that they might have to, replace in the next year or so. So they're just, the premiums are getting quite high. So, I mean, that's just pushing down on affordability and, in turn on the price.
So go back to the Denver stats here. So our pending is up 6% year over year. Our close is down about 1.5% year over year. So kind of seeing the same trends in Springs. We're seeing some interesting stats on there. I mean, you guys look at this too. Jeff, Troy, anything jumping out to you here on these numbers that you want to chat about or kind of surprise you?
We're seeing that close to list ratio finally come down a little bit, but man, it seems like with how soft the market is, you'd see a little more like we were talking about. Surely there's some pain out there where people will take a lowball offer. Yeah. But yeah, we're still at basically
no one's making the
99%.
Yeah. Here is something, this jumped out of the commentary in the DMAR report. Active listings typically increase by an average of 12.3% from May to June. This year's 3% increase signals a potential cooling in inventory. So interesting to see that. I mean, that's a pretty dramatic shift from like we've seen the inventory really jump up. Maybe it'll start cooling off here a little bit. We'll see you next month.
I think the interesting one to me is days on market. I like that one. When it hits over 30, that tells you a story right there. Like average days on market, you can see for June 2025, 37, right? And then a year ago was 28. So stuff's taking longer to sell. That's where like the true test of these motivated sellers. You want to find the ones that have to sell, right? And the ones that are, but you could also say how much is that because they want their wish price. Like, oh, my house is $700K because my neighbor 3 years ago sold his house for $700K. But the reality is that was, 3 years ago when Troy was pushing rates down. So now it's
That's right.
much harder, right? So in the markets, there's way more to choose from, right? So buyers can be a little more picky and they don't have to make up their mind in 5 seconds anymore. So that indicator is a really good one when it hits over 30 because that now it's over a month. And I'm not sure what it was at the peak, Chris. Maybe that might be a good metric to look at.
At the peak of
like 2012, when we had like 25,000 active listings, like what the days on market was there. We had a ton of when it was a complete buyer's market.
Yeah.
I'm kind of curious on that one, days on market. I'm sure it was like in the 50s or 60s. I better.
Well, I don't see the days on market. I'm gonna flip over to another chart here, and I got a few charts for you. Keep that in the back of your mind. I'm flipping through a bunch of charts here because what was interesting, and let me switch the screens here, because every quarter, Your Castle Real Estate, they publish a quarterly trends report, and I had a few graphs here I thought was really cool to talk about. So here is the solid line is homes, and then the dashed line is condos. So you can see the homes here, I mean, they shot up during COVID, and it's been, kind of plateau and slightly going. Now, of course, we all know different asset classes, different submarkets. Say some are going up higher, some are seeing declines on there. But overall, like, we've been flat with a little bit of upside. Condos, you're starting to see them come down here. Like they are peaking in that standpoint.
There was something I read in an article was the luxury condos, like the months of inventory was like 17 or something. Like they're not moving at all.
Wow. Mm-hmm.
So I don't think they have a graph for days on market, Jeff, but this one I saw, and we'll see if there's more, but this is months of inventory, which is another way to look at it. So you can see here we are at about 3.5 months of inventory here in the end of Q2. And then back at 2008, 2009, we were at 7 months or so. If you go all the way back to the 80s, we were at 10 to 12 months of inventory. So we're still a ways off from anywhere we were. What's interesting right now, so according to months of inventory, we're still in the seller's market because we're below 4. But if you go to inventory, based on the inventory, which is almost 15,000, we're in a balanced market. So a little bit, two different stats saying different things. But I think, inventory will lead to higher months of inventory and higher days of market. So I'd imagine the other graph to start picking up here. But like for a lot of it, we're balanced market territory. And then, condos and townhomes and things like that, we're in a seller's market.
Yes.
For sure. Any other comments or graphs you guys want to look at on here? I feel like we spend the whole show just looking at these charts.
Right.
All right. So let's move on to some articles on here. Brand, I'm going to pull us up, but tee us up that one on CoStar you found about the apartment rent growth, and I'll pull it up here as you start talking.
Yeah, this is just something I've never seen the graph this displayed like this before. So it's month to month rent growth, or the opposite, rents falling, going back about 5 years, and so you see this seasonality of it, that you tend to have rent growth. 2020 was a weird year, so you had some rents fall in like March and April that year, but for the most part, you see, the first half of the year is marked by rent growth month over month, and then at some point later on in the year, you see some rent losses month over month. And so really you can see, and it's the kind of combination of that upward swing and the downward swing that says are rents moving up overall or down overall. And you can just see 2023 looks like it was about flat. There's about as much rent growth as there is rent loss. And then 2024, you start seeing an imbalance where the rent growth was less in that first half of the year, and then some big, rent loss months in the later half of the year. And then the first few months of this year, just has been not great. And it was the first time we've seen February be negative since like 2020. So
yeah, I was surprised by that. And I'm kind of curious here because I know we have a lot of inventory still coming on through, probably early next year with the apartments, and that falls off a cliff. But at some points, all right, no one's buying homes, or like they used to be, right? Really, really low. Inventory is going off. Well, if people aren't buying homes, rents are going to start going up, right? If you're not buying a home, you're renting, and that's going to drive demand for rents. And I think, unfortunately, a lot of first-time home buyers are going to get, pinched where they can't buy a home or don't want to. They're renting, and that's going to start driving up rents again. So, this is why, like for a lot of people out there, why house hacking. If you're on the newer end or looking to get into real estate investing, house hacking is like the no-brainer way to get into there.
For sure.
Because hey, you can find really good deals out there, and you're your living expenses will be greatly subsidized or even potentially free or making some cash flow.
Yeah, we got so sick of this argument that like, does it make sense to buy now when at some point in the future you might be able to get a 4.5% rate or something like that? It's just like that. Everybody got kind of sick of hearing that and waited. People who did buy when they were first saying that rates still haven't gotten good enough to refinance, kind of thing. But at some point, that argument's going to be really true, where it's like, man, I wish I could buy that property at the 2025 price.
Yeah.
But now get the 4% rate.
I mean, you can argue that since probably 2009, people said, oh, well, the bottom hasn't hit. You should wait till 2010. And then 2010, well, you're getting a bunch of these, what they call it, like the baby boomers are going to retire. So they're going to sell off all this inventory.
Yeah, when is that going to happen?
And then 2012 hits, and then it's like, well, there's still too much. You should wait. It still doesn't bottom out enough. And then maybe, depends on the market, of course, too. Every market's different. And then like 2015 hits, it's like, well, rates, you can find an excuse for reason not to buy if you really think about it. And then like COVID hits, like, well, there's too much demand, you're too much competition. Just wait for things to slow down. And then now you just missed out on all those 2 to 3% mortgages. Yeah. And then post COVID, it's like, well, things are too high and too expensive. And then you're right. In 10 years from now, people are like, oh, I wish I could have bought that place at 2025 prices. Yeah.
So Brandon, what are you seeing in the Keyrenter portfolio? Like what are the trends you're seeing in terms of like your rents and different, asset classes?
Yeah. I mean, big picture, we're just seeing there's not new investors buying stuff. Very, very little of that. Or even seasoned investors or any investors buying homes and immediately handing them over for us to manage. But yeah, for all we get, we're still getting a lot of the accidentals or people moving out, that kind of thing that need management. Overall, yeah, rents are just a little softer. Things are taking longer. So same old story there that we've had the last.
Would you say overall your rents are a little higher than last year? About the same, a little bit less?
I would say a little bit less than last year.
Okay, like portfolio.
So we're seeing year over year, a little bit of
and
drops in rent.
With the accidental landlords, so people moving or, people getting married and taking one house turn into a rental, like are you seeing, because I know for a while there you saw a huge influx of that happening, right? People had the low interest rates, some equity they were turning into. Are you seeing like
that machine hasn't slowed down?
So you're still seeing a higher than normal volume of like the onesies and twosies coming in from the accidental landlords? Yeah,
we still see a lot of those. There's been more lately where it's like, I've got this condo and like, I'm thinking we could, my all in, I need to make $2,000 a month to break even on this. And we're like, unfortunately it's probably at $1,600 and it's not going to fly off the, shelf at that price. So be prepared that it'll take 45, 60 days to find a tenant at that price.
So are most of them like still renting? Hey, they'll take a $500 loss versus maybe a 25% hit if they sell it.
I was talking to someone in our office about that today, and he's like, I feel like I'm shooting straight with these people just because we really don't want to bring them on with an overpromise that we can get this rented, no problem, right? But you always got to think someone out there maybe is. I don't know. So he's like, I've been shooting straight with these condo owners, and I'm not hearing back from a lot of them. So I don't know what they're doing because we don't see the transaction volume indicating that a lot of these are selling. So maybe they're just kicking around options or
maybe PMs are like brokers and oh yeah, you can sell for that price for a business seller, right? Like, and then sell them the dream and then take them down.
I'm curious if they are going to try and save a few bucks and self-manage.
I'm sure we're getting some remotely of that. Like,
or something.
I'm looking at a $400 loss, best case scenario. Yeah, I can't afford another couple hundred on a PM. Yeah. In some ways, it's like, I don't know if that's the right way to think about it. Like, it costs what it costs regardless. But I think for some people, it just feels intolerable to take the $600 a month loss or something.
Jeff, Jenny, you guys got any comments on your portfolios or things you're seeing with your clients?
In terms of portfolios, same as last month, just trying to keep everybody happy. Not doing a lot of renewals, thank goodness. I think I'm going to finish out the year. I just have like one more person that needs to sign, I think, with 100% retention rate. So that was a first for me in almost 10 years. So it's pretty good. Great. So like I said, just, trying to keep everybody happy, I think.
Yeah, most of mine, portfolio wise, mostly some tenant turnover. but sometimes it's good because you get the ones that you're like, okay, well, I could get a better tenant in there at a higher price, or one that is less likely to move because tenant turnover usually is the biggest cost for most landlords or PMs. And then rent growth. Yeah. So for all my properties, I did kind of increase majority of them. So I am up year over year. About small, like 3-4%. And still working. It's that balancing act, as Jenny knows, is yes, you can push for, and Brandon knows, you can push for the increases, but they could say, well, if I'm paying $1,300 over here, and you're trying to push me at $1,375, and the place across the street is charging $13, they might just decide to move, even for $75, something small. So it's not. Luckily, Jenny and I have small portfolios where we could have like close relationships with the tenants and understand that kind of the balancing act, right? Of do I push it now or push it later? Because I don't want to have tenant turnover and have to find a new tenant maybe at a lower price. But still, the tenant turnover I'm having now is all positive stuff. I'm actually excited. One's switching to a second sober living home, and the other one is a Section 8 tenant moving out of state. So. And it's more of a messier Section 8 tenant. So happy to get that place all cleaned up and re-rented. But overall, yeah, up year over year, still try to find increases. And I do, 4 strategies. So it depends on the strategy too. And sometimes Section 8, especially with all the changes, they've capped like annual rent increases. But I did get them before they did that for a couple of them. But the more recent ones, not so much. And then my market tenants, just normal tenants, that's been just having conversations with people. And then rent by room people, usually those, if they're good, I keep them. I don't try to push them just because they're more price sensitive since they're affordable housing part of the market. And then sober living, I do have that actually in my leases, a 3% increase year over year for
you have a master lease on there, right?
Yeah. So it's like a 3-year lease and a 3% year over year baked in rent increase.
Nice.
So I got killed last year with delinquency and starting the eviction process and vacancies. My rents are about flat, but also I've just had to knock with a lot less delinquencies and then leading to that. But man, that just crushed me last year in terms of cash flow.
Yeah.
I think part of that too is obviously it's gotten harder to evict.
Yeah.
But now I think we're getting better at navigating the market. All right, another article here. So this was an article from AP, and they quote some data from a company called like Batch Data. But I'll read a few things here. Between 2020 and 2023, the share of homes bought by investors nationwide averaged 18.5%. Now, nearly 27% of all homes sold in the first 3 months of this year were bought by investors, the highest share in the last 5 years, according to Batch Data. So even so, investor-owned homes account for roughly 20% of the nation's 86 million single-family homes. And this is where I think the stats get interesting. Of those mom-and-pop investors, those owning between 1 to 5 homes account for 85% of all investor-owned residential properties. With those owning between 6 and 10 properties, account for another 5%. Institutional investors own 1,000 or more homes, account for only 2.2% of all investor-owned homes. And now the group of 8 of the biggest companies that own and lease single-family houses, 6 sold more homes the second quarter than they bought. So really interesting because you usually don't see a breakdown of like, mom and pop investors like us and, the versus institution. But also goes, I know there's, a lot of people don't like institutions buying it, but they're still such a small part of the overall market share, right?
Yeah.
I mean, 2%, maybe 3% of the market is owned by
That's kind of
institutions.
surprising.
Yeah.
I thought institutions would be a lot more.
You thought they'd be higher?
Yeah.
Yeah.
Did you? Did you think the institutions own more?
I thought they'd be around there because I've had other people share. It's just like everyone's like it's been lower than that because I remember for a couple of years there was a lot of like people hate them buying up everything.
But this shows they really haven't.
Yeah, I mean they own some, but I also know like I've got a couple friends, at least here in Colorado. They did a lot of like brokerage stuff for not one of the I don't think one of their 8 biggest, but a name a lot of people know here, and they've just been disposing of their properties. And part two is interest rates. They're no longer getting the positive leverage arbitrage on that anymore.
Right.
It's interesting, like just putting some of this data together that 6 of the 8 largest have been selling more than they've been buying this quarter, yet the percentage of total sales by investors is up. So it just makes me think more what's changing here is the amount of sales is down, right? So it's not like these investors are going crazy with it, but it's just the fewer transaction volume, that percentage has grown.
Yeah. I think it also have different buy box, especially like, this is national data, right? So they got the great assault by, I've seen the article, especially in like some of the Midwest markets, like, those markets that are $100,000 for homes, like the amount of investors going there now has just been like a huge jump, right? It's affordable. Buyers aren't buying them. Investors going there, scooping up a lot of stuff as well.
Yeah, and you're moving out of these markets that saw massive appreciation the last 5 to 10 years. So you're sitting on a ton of equity that you can cash in on in those markets.
I mean, if I had the ability and the balance sheet where I own 500 homes in Colorado and I had the operations risk up, I'd sell all those, go diversify, take the appreciation from here in Colorado, go diversify to other markets, go set up your property management, your acquisitions team in Iowa and Kentucky or wherever, and go scale up elsewhere. Like, to me, that would seem like a no-brainer play. But I, unfortunately, don't control that balance sheet. All right. So some other articles on here. So for some new build numbers on here. So this is just some, I heard through the grapevine on here. So a builder here in Colorado, they were forecasting to sell about 40 to 50 homes in June and May. So, almost 50 homes between those 2 months. Do you guys know how many they sold actually? Like we talked about for the podcast.
6.
Well, my dramatic pause there, I backfired on that. I gave you guys the punchline.
Was it 4 in May and 0 in June?
Yeah, it was 4 in May. Someone's listening. Thank you. 4 in May and 0 in June. So,
I didn't want to spill the beans.
I thought Chris was gonna. There's one.
I don't want to.
Right after I said that, I was like, "Oh, I delivered that so bad."
Should we pretend again?
Oh, well, I think the cat's out the bag on that one. Yeah. But so they're at about 10% of their forecasted homes. Now they are very, Denver County centered, which is, I think, Denver's getting hit a lot more than outside parts, but like 10% of it. And they were showing they have over 100 homes in the inventory. And in all of May, they had a total of 26 showings across over 100 homes. And rewind, 3 or 4 years ago, one home would have gotten that amount of listings in one weekend.
Absolutely.
Like, isn't that just
they could have that many offers?
Yeah.
Yeah, it's just amazing how little activity there is.
Yeah.
Like, you understand some of the deals don't pencil out or something, but just how few people are even looking. And
do you know where the price point is on those? By chance?
I think a lot in that like 6 high 5 to like 700 type price range.
Yeah,
maybe a little higher too, but I mean nothing.
That's where the meat of it is. So.
Yeah.
Yeah.
Well, it's just simple. Who is that person that buys that place, right? Probably not investors. So it's just normal homeowners. And what are they doing right now? They're freaked out. They don't want to buy anything. They're scared. They read the headlines. They waiting like they want Troy to drop the interest rates as soon as possible. And Troy's doing what he can, but can't really do so much.
Yeah, exactly.
And I think the fear of that's just kind of like the opposite, right? So it was a frenzy during COVID. It's like, it's like free money, 2% interest rates. Let's just make 10 offers on all these properties and 100 showings. And that's what it's like the opposite of that. So complete high interest rates, high prices, new first time home buyer, probably majority of that demographic. But they have to have pretty high incomes to qualify for a mortgage in that 600 to 700K.
It becomes an affordability thing.
Yeah,
and
I think
those numbers would almost tell me like, some of these smaller developers, maybe not this one, but like we may start seeing some of those mid development. They realize or they run out of money and can't. I imagine the money behind these things, if they need more capital or something, is not easy to find and that kind of thing. So.
No, I mean, I got a couple of interesting data points on just, talking to other investors. So, like a hard money lender I know in town, they have some like new build projects they're in the process of foreclosing on or have as well. And their delinquency rate has ticked up quite a bit because they actually have to foreclose on it. They couldn't, come to an agreement. There was a couple I was just kind of giving some guidance to as they were out there. They were selling property out of state, bringing a lot of equity here to Colorado. They were 1031 to like a handful of properties, and they got some amazing offers on some new builds. Where I think they were the list price new builds, and these are standard, like, your 3-2 type, townhome, communities, pretty standard stuff we see in Denver and around here, right? High 500s. They got 3 or 4 properties in like the high 400s.
Oh, wow.
I mean, so like a 20% type discount.
Nice.
And of course, that was kind of like the investor special and plus some other incentives on there as well. Nothing on the financing side, but just got a really good price. I know some other just, builder incentives on there. But like, I mean, that's a 20% discount on a new build. Like
they were buying them to rent?
Yeah.
Okay.
So they're doing 1031 out of California. So just, taking a lot of high equity from there. And now they live in Colorado and bringing the money out here. And so they got like, I think a stellar deal on there. And just some great incentives on there as well. And so I think that's another area to look at. We talked about, but man, if you're really looking for offers, go around and talk to builders as well, because there's some real pain. And when those guys have their construction loans or bridge loans, and they're coming up on their timeline, they're past it. There's maybe some abilities to unload there too. And some of the developers too, they're at high leverage as well. Like they have to liquidate.
Yeah. This isn't like your homeowner who's like, well, I can just pull it off and sit around for another year. It's not that bad. We'll just keep living here. Like, yeah, there's very different set of motivations on this one.
Wow.
And they're not locked at 3.5 for 30
No,
years.
that construction financing wants to be taken out.
Yeah.
Oh yeah, I mean they're
Wanna be
going to
paid
be
off.
at, anywhere from, if you're with a bank, 6-7. If you're a hard money lender, you're in the tens or low teens on there.
Yeah, and they'll charge a fee to extend.
Extend it. They're charging a fee, and also they're
get hit. Yeah.
All right, so another item here, Brandon. This was an article you shared about delinquency
Yeah,
on some commercial loans.
This dovetails nicely because we're talking about this. This was coming from the side of what are the banks doing with these commercial real estate loans, where they have been. I mean, we've already had a couple of years where they've hit timelines. They don't want to extend, but they're a lot of what's happened the last couple of years. And I think some of this is in the wake of like in the last downturn, everybody was foreclosing and banks were taking back properties like crazy. And I think we really saw both on the residential side and the commercial side, like that was not great for everybody involved. Like banks don't do a good job of owning hundreds of homes all over, and even just the cost to maintain them and keep squatters out and keep from getting fines from the city and just not letting
Pipes
them
freezing.
Yeah,
all
totally.
that
It was
stuff.
just a mess, and so everybody's been more leery to kind of go back down that road. And so there has been a lot more of extending the terms and offering renewals but this wasn't the short-term little, okay, we got to get through a little pain and all of a sudden we'll be back to this active, efficient market. We've seen this like extended period of like, it's still not getting better. The rates, they aren't able to refinance. Lending guidelines are tight. So it just talks about we're coming up on this, like these banks are really having to make hard decisions on maybe it is time to foreclose, take some of this back and figure it out.
Yeah, a few commercial brokers, like apartment brokers that are around town, they were saying, beginning of this year, like they're actually seeing banks start the process, kind of, hey, we just have to take this to market and get rid of it. And they're like, we haven't seen that for years now. It's all just been the extend and pretend. But they were saying, hey, we're actually starting to see the process now. That takes quite a bit of while to actually take through it, but there's sounds like the early beginnings of it.
Well, a colleague of ours said he's bought a few now from relationships with banks where they basically are like, all right, we're not going to extend anymore. And they just, or maybe they're at the point.
Are these homes or apartments? Or
This is apartments.
Okay.
Where maybe the banks now have relationships where they're like, we know an operator we trust. We're just going to move it off our books quickly and get it off to someone who can operate it and make this work.
No. I think there's going to be some, we talked about, I think there's going to be start seeing some really amazing deals on like the commercial stuff. Office, I still have no clue on. They'll eventually find a floor, right? But for apartments, they're coming out to market. I mean, people have to like get them sold. Like that's real distress. I think there's a lot more real distress in that sector than a lot of real distress we're seeing in like the residential, because we're sitting on high equity and 3.5% 30-year fixed debt.
Yeah. There was another article I didn't include here, but Bet365 just moved headquarters here.
Oh, I saw that. Yeah.
and they were offered like $14 million in incentives from the city to, because I think the city really wants to see this stuff occupied and all the economic activity that brings. It also had to do with their average wage was like $89,000 a year or something like that. So the city really wants to bring these higher paying jobs in too. So some of it, they had to hit these tiers of a certain amount of hires at certain rates over the next few years or something. But
I think that's great.
I do too.
I mean, we need those to start getting downtown and hopefully, gosh, save. We were talking about last month, save those businesses on 16th Street Mall and everything.
Yeah. This was right there, like 17th and Platt.
Chris, can you segue? I know we kind of teed it up before the show. With these big deals, what are you seeing for syndications? Since I don't think any of us are in syndications, I'd be curious to get your take of kind of how we're doing on that.
There's a lot of pain out there. I mean, you guys have probably seen some of the headlines, or if you read like the Bigger Pockets forum or Reddit forums. I love going down Reddit forums on real estate. It's very colorful. I mean, a lot of those like LPs, and these are people I read and just other investors I talk to. I mean, the amount of people getting zeroed out is, I mean, it's happening a lot. I mean, like it goes to zero. A lot of syndicators or funds, they're bringing like pref equity funds in, which is basically like it's a different part of capital stack. So they're starting a pref equity fund, over here, say pref equity fund 1, it's a right pocket, and then that is investing in deal number 1, their left pocket. So that deal is not being foreclosed on, but what that does essentially washes out like the original LPs in there, the original investors who are common equity. And so it's not a foreclosure on paper, but then it basically wipes out their existing investors. And it's a strategy some people are doing. I think it's not the way to go, but hey, that's not my deal. But it saves the deal for them and also keeps their fees coming in. I did, for the first time I heard just from investors I know, a bunch of people were in this one deal, and the LPs actually took the deal over and assigned a new operator to it. So they actually hired a lawyer, got enough consensus, and it's a hard thing to get enough LPs to actually vote on it, agree upon it, put some money in there to hire the lawyer. They actually went in there and hired the lawyer, got it all done, voted on it from like a corporate LLC standpoint, and then hired a new operator in there. But I've also started seeing some deals too where hey, it's the 2008 foreclosure thing where, hey, this deal sold for $100 million 5 years ago. Oh, some group just got for $20 million, right? Like, you're gonna make money on that deal. So there's some stuff out there. I'm happy so far. None of my deals I've invested in, they're all doing relatively well. Like, most are doing pretty good. A lot in the Midwest, which I diversified out there. A couple deals in Denver are they're having their struggles, but fortunately they were bought very right, but also had really good debt structure on there, where it's like, oh, we got 7 years of seller financing at 4% IO. Okay, well, it's not performing like we're hoping it would. We could ride it out for a couple of years until the market improves enough to sell it or something like that. This is interesting. So a hard money fund that someone was invested in, they got their latest quarterly report, and they are at 19% something delinquency.
Wow.
So it was, I forget the exact numbers, but it's like ballpark 7-8% REO, meaning the fund took it back and owns it. And then 6 or 7 or 8% in foreclosure process. And then whatever the remaining 1, 2, 3% was in like 61 days or late in payments.
Jeez.
I was,
a lot of those hard money funds that I'm familiar with, they are not set up to like operate deals and do all this either, right? Like that, they have not had the infrastructure, because like a lot of them have not foreclosed on a single deal, or it's been 1 or 2 in the past 5 years or something like that. So I can't imagine what a pivot that is for them to all of a sudden.
The interesting thing on like that deal, like so far, I mean, they're no principal loss. They're still paying out dividends on there. I mean, that's part of like, hey, they were first position bank debt on there. So they're not getting wiped out or anything, but even seeing like the stress of that level was very surprising to me. Which, hey, you look at that, you take the builder chat we talked about, the build deals we talked about, like that's some real pain happening, which, I mean, we haven't seen that lately.
Yeah, it's not a time for newbie investors who don't know what they're doing or investing with the wrong guy.
I'll play counterpoint on there. Like, I think this is like, whether you're buying a rental or looking to go passive, I think this is some of the best times to buy, right? Like,
Sure.
and because I talked to a lot of people coming with the podcast who want to invest, it's the same thing. Everyone wants a crash, right? Oh, I wish prices were lower.
Do you know what it actually feels
Yeah,
like?
there's blood in the water. Everyone's too chicken to go out there and do it.
Yeah.
Or actually, never, but a lot of people are too scared, which I understand. But same thing, like, hey, you want this. When you're going through it, man, it is scary as hell.
Yeah, it's easy in retrospect to be like, oh, why didn't I jump on those opportunities?
Why did I buy in 2010, 2009? It was scary back then.
You did buy that, Chris, in 2009.
Well, I'm saying because I was just like, I've learned to be contrarian. Like, hey, if everyone's doing this, I've made good money that way.
And also banks tighten too. This is what people don't talk about. So banks, what happens when the market goes sideways? They start changing their underwriting standards. They tighten up. Was it Troy? So I don't know if you remember this. So I didn't buy anything back then, but didn't they used to allow 10 loans? And they said, oh, we're changing the policy now. You can only have 4 loans under your social security number back around 2012. Boy. So, and most people, it's harder to get a loan back then too.
Well, yeah, kind of what contributed to that whole thing too was the loose money, the loose guidelines. That's what I really remember is like fog a mirror. You got a loan, it was all credit score based. I think one of the peak things I saw just for a little bit of entertainment is an investor came into the company when I owned my own company, and they had a product and program. You had to have a 680 credit score. You could do an 80-20, so 80% first, 20% second.
So zero down then.
Zero down with a 680 credit score. Didn't verify any income, Chris, on an investment property.
Nice.
So you could buy an investment property with no money out of pocket.
What happened to that guy?
They had a little website called the Implodometer, and that company was number 5. And it ended up being hundreds of companies that went under because of these low doc, no doc products and programs. This company was number 5 on, there was the first one, and they were the 5th one to go out. Wow. I mean, they were doing crazy crap then. But that's what contributed to it, right? Yeah. These loose lending guidelines, people couldn't really pay for it, and then everything crashed. And then there was people with good loans that could afford it, but they're like, my house is worth $100,000 less, so I'm gonna go out.
I think that's a problem too. Is people have equity now as well, so
that's what's helping us big time.
Like, you almost say, if I don't get my $700K price, or like Chris, he said, if I don't get my price, then I'll just wait out.
I don't need to. I still cash flow almost $1,000 a month.
Yeah. Imagine this is 2009, and you're an adjustable rate. No money down deal, and you have no equity, and it's about to adjust up from like 2% to 8%. Now you're a little more motivated to sell.
I'd walk away then, right?
Yeah, you just get foreclosed.
And that's what they did. They were renters that didn't have anything much invested, so they had nothing really to care about to walk away. It's like, it's for closing. I'll just go back to renting.
Yeah,
and they had no skin in the game. They came out with nothing less than what they came in with.
The blood in the water now is very much more the professionals, right, or the people trying to flip, or the developers or something. It's not the average homeowner.
Exactly. I think that's the case for sure.
But kind of ending on a positive note here. I mean, like we're going through the stats here, but like on this, like I think this next half of the year, we're going to see amazing opportunity. Like I actually think like Denver single family home prices overall, I would not be surprised if they dip negative a little bit, which I have not expected. But like based on the data and this other stuff, like I would not be surprised. Next 6 months, year over year type time frame, we would see a correction. Not like a 2008 or not what apartments or condos are going through, but something on there. But I mean, and then, hey, they might probably improve next year or maybe stay the same. But I think if you're out there and want to get in the game, whether you're a new person or that, like this is time to get in there. Like there's good opportunities. Go look at new builds. Go make 20 lowball offers on properties with Jeff or whatever.
Disrespectful offers.
Disrespectful offers. Thank you. Like I think there's opportunities. And like the syndication side now, like the deals, like the people who have deals that went sideways or are like, that's the internet, that's public, it's washed out those bad operators. And so the people that are still around are, for the most part, still always do due diligence. They're good people that navigate the market. They probably took a few black eyes, but they've got the durations. And now like the deal flow is starting to come back on both of those. Like I am very I'm bearish on the market, but I'm bullish on the opportunities.
Yep, I would agree with that.
And I wish I had more capital now.
Yeah. Well,
to go out there and buy some of these deals.
We've got 2 fourplexes closing next week, and those pencil out great.
Yeah, what's the high level on that? Because you're doing the debt on that, and you're
both
doing
of those.
you did the brokerage
one of the
stuff.
buyers.
Yeah, we've got one in the Springs, one up here in the metro area, and those have great numbers and pencil in really well. And then even Jeff had a couple offers on a couple duplexes a few days ago, and they were on the market for a little bit, and kind of not a complete disrespectful offer, but we're in conversations with the sellers, and the listing agent, so we're in the game, and those pencil.
That's
well
how
too. So there's deals to be had
because there's lack of, even for the 2 to 4 units, small multis. Single families, usually those don't pencil in Denver Metro or Springs. Correct me if I'm wrong, Jenny. Besides your properties, if you bought a single family, unless you're doing a Miller rent by room style, you're not going to pencil that as a normal long-term rental.
For the most part, yeah.
Yeah. Without any creative strategies. It's like normal rent to normal tenant. So, but the same thing in Denver, like a $600K house doesn't rent for more than usually $3 or $4K at the most, unless you're in Cherry Hills Village, but then you're spending $5 million for that house.
Right. Sloan's Lake.
Yeah. So then you have to find that balance angle. But the good news is, Chris, you just alluded to it. We should end on a positive note. When people don't want to buy, or there's a lot of fear in the market or uncertainty, that usually is a time you should take advantage of that, because we won't always have this fear and uncertainty. Eventually it'll flip another way when rates do drop below, I think the cut was at 5.99, Troy, when people really come in waves.
Yeah.
Like that will be like,
I think we start touching consistently in a 5s.
Yeah.
I think we'll see.
And if that happens, then that offer, then prices will go back up, and
or you won't get the concessions.
Yeah.
To help you.
I think one thing that's important too in a market like this is like the opportunities today do not look like the opportunities from 10 years ago or the last crash or whatever. It's very different. So it doesn't mean there's not opportunity, but I think it takes some creativity to spot like where they are.
Exactly. Also pivoting strategies. I mean, room by room rental right now is if you want to go cash flow, like that's the best cash flowing rental strategy. Troy, I don't know, I'm going to butcher this, but I've seen this article or this data point across a few articles, but I forget the last like couple months. It's been like, it seems like every single month, every single week, there's like more mortgage applications. And there's been like, it's been very like, seems like a very steady, slow uptick, like more than it was last year and ever so slightly increasing. It's some data I've seen and just headline reading.
I think that's reasonable.
And I mean, obviously they're not coming through yet, but like, to me, that shows, hey, more people out there getting prepared and ready for it, which is good for you. That might allude to what Jeff was saying. Hey, if rates drop or people come back to the market, like it may spike, but like, man, if you want to go out there and buy a property, like probably not the best time to sell and do a 1031 exchange, right? But if you got some capital or some properties to sell, like there's one investor I talked to, he's got a couple condos and he's been trying to sell them. He's like, damn, I'm just going to drop the price by $50,000. He's like, I don't care. I bought this for $38,000, 2008. Bought this one for $42,000. I sell for $240 versus $290. I don't care. But I think it's capital. I can go out there and just get such a 10x return on there right now by redeploying it, right? Like, so I think there's a lot of like good opportunities out there, and you can.
I would agree.
Yeah. So like to end on a positive note, I mean, man, this is. I think I know you probably said it a few times now, but like, this will probably be the best opportunities we've seen so far in this kind of transition. Might be the best. But like, there's some opportunities. Of course, go out there, underwrite the properties, do due diligence, make sure the properties work at today's debt, at conservative underwriting with the lower end of rents, and taxes and insurance and expenses. Don't expect those to drop anytime soon. But like, be conservative underwriting. And Jeff has been great. Like, you always make sure the numbers work today. And you've always got your clients that way as well. Like, I think there's some really good opportunities coming up where you can buy like a great asset at a good price.
Yeah, and not super aggressive, income strategy, right?
Yeah.
And Jeff has always talked about and preached quite a bit is, have your strategy, but have a backup strategy. So if that one doesn't play out or something changes, you can pivot, and it's still going to pencil. It's still going to work. Yeah. And we've had some good success through this year, with the market being where it's at and with the rates being where it's at. There's still deals to be had. And we've brought it up before. You've been consistently buying year over year over year, and the market's continually changed, but yet you're still in the game, playing the game, and making it work.
Yeah, if I was a flipper, obviously I have a different story entirely, but I am a buy and hold long-term investor, so I don't care. If I overpay by 10, 20K, I'm like, I don't care. As long as I just care about cash flow and I want to make sure it works today. And then I'm not planning on selling in 5, 10 years. Like I'm like buy and hold for 10, 20, 30 years. So I will write it out and make sure it works and make sure cash flow is day one. And if rates do drop, great. I'll look at a refi. If rates don't drop, great. I don't care. Like I'll just make sure it works from day one. But where do rents go over time? In general, like in any of our lifetimes, I don't think if rents have gone down. I guess, Brandon, have rents ever gone down since you started your property management?
Yeah, in the last year and a half.
Slightly.
I think up until
we've never had a crash in rents.
Like
Denver
2%,
Metro.
something like
No,
that.
it's always been
Modest.
very modest.
Yeah.
And like historically, we've seen it's more like rents flatten out for an extended period of time. And there might be a little bit of drops in there, but you tend to have big rent growth periods and then flat periods. But we don't often see like double-digit drops.
And I remember looking at like rents, like I think I might be misquoting the data point, but it's that there's never been 2 years a row of negative rent growth. Hey, 1 year has happened, a couple times, but like 2 years hasn't. So like, we don't see the rent crashes like that. Yeah. And I've heard people like in 2008, like, hey, rents didn't crash, but the quality of the tenants crashed. If you get Class C properties, you get Class D tenants. Class B properties got Class C tenants, and that was like the biggest pain point, just the quality of the tenant you had. So there you go. There are deals out there. There's opportunities in new builds. There's deals out there in some people are distressed sellers from death, divorce, job relocation, in the resale market. There's opportunity out there. There's opportunities out there in the passive stuff as well. Like really good time to go out there, and I think start getting aggressive in terms of like looking for things. But always go out there and be smart. If you guys have any questions out here, we all have areas of expertise. We all love doing this stuff. Reach out to us. We'll do the best help we can, or point to the right direction. Hey, go talk to her or him instead. But like, be aggressive out there. Be my opinion. Be aggressive and be smart.
Absolutely.
Agreed.
I agree.
Cool. All right, this was fun, guys.
Yeah.
Thanks, Chris.
So we'll see everyone next month. Bye, everyone.